Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Our goal with this podcast is to sit down with top market practitioners, learn about how they approach the markets, understand some of the tools and techniques they're using to understand current market conditions, get a sense of their outlook looking forward from today. Great interview today with Jeff Hirsch. Jeff is the editor of the Stock Traders Almanac. Jeff's father, Yale Hirsch, is credited with popularizing seasonality and seasonal trends and promoting the benefits of looking at seasonal cycles, contributing many sort of words of wisdom and seasonal wisdom that are taken for granted by modern traders and modern investors. Had a great opportunity to ask Jeff about surprises through the course of 2025, comparing what actually happened to the traditional seasonal playbook or the traditional playbook for a post-election year. Then we looked forward to 2026. What does the Stock Traders Almanac tell us to expect over the next 12 months? What is a midterm election year? We'll look at the previous midterm election years, talk about some of the macro influences that could cause a diversion from the seasonal tendencies. Great interview, I hope, kind of dispelling some myths about seasonality, but also giving you some specific ideas about what to be looking for and thinking about in the months to come. Enjoy this conversation, please, with Jeff Hirsch of the Stock Traders Almanac. Super excited to be chatting yet again with Jeff Hirsch, editor of the Stock Traders Almanac. Jeff, you are the go-to expert on all things seasonality. I thought it was a very opportune time to sort of take stock in terms of what's happened in 2025. Look forward a bit. We've got things like the Santa Claus Rally, the January effect, some other things I think investors should probably know about. But to start off, how are you? Hanging in there okay?
I'm good. 'Tis the season for seasonality, my friend. This is it.
I would imagine, right?
Yeah.
I would think so. And it's so funny. It's true that there are a couple times a year where I think people just remember that seasonality is a thing they should know more about. And for me, it's that when I've talked to you, I realize how often you get caught in that trap of like in May, you think, is it sell in May? In December, you start thinking Santa Claus Rally. And what you've taught me over our conversations with you, there's a lot more to it than just those 2 points on the calendar. And particularly things like the 4-year cycle, we're going into a midterm year.
Yeah.
These are all things I think that hopefully we can tease out in our conversation together.
For
So
sure.
look back with us first, Jeff. I mean, when you look at 2025, obviously I feel like it's been such an unusual year in so many ways, particularly this huge macro driver, this AI euphoria that has really caused asset prices to go higher. How would you think, looking back at sort of the traditional seasonal tendencies and what actually played out, what made sense in 2025? What surprised you, if anything, about how this year has played out?
Well, I think as you mentioned the 4-year cycle, the fact that the post-election year has been the strongest year of the 4-year cycle since '85. We're seeing that. The
Yeah.
seasonals got turned on their heads with the tariff, Liberation Day, the tariff tantrum, the tariff tumble,
Yeah.
a very fast downdraft. Looking at that, it's starting to look like, though it wasn't a classic or official bear by many, definitions, it may very well have been a reset. I mean, maybe at the first, in the beginnings of a new bull market. We'll need a little hindsight to look at that. So we had the worst 6 months, the sell and May period, very positive, and when seasonality doesn't work, it's an indicator. So as Edson
Mm.
Gould said, if the market doesn't rally during bullish seasons, there's a sign other forces are at play. When that season's over, those forces will really have their say. Conversely, if the market goes up during the bearish season, there's other forces. AI, the tech boom, it dovetails into my super boom cycle analysis, that the book I put out in 2010. So it's been an interesting year. I'm also diving into some of the fourth turning stuff, which is another cycle. I don't know if you're familiar with some of that. The
Yeah.
generational stuff. I'm currently fascinated with it, trying to correlate it with my super boom cycle, and it's interesting to me. But so we're at that in that crisis period. What's happening this year with the battle between left and right and blue and red and Democrats, Republicans, and Congress and the White House, and there's all sorts of crises going on, and I think that's what we're seeing this year. And on top of that, we've got this tech boom, which I think is secularly early on, but we might get a little pause, consolidation over the next year or so. We'll see. But
Yeah.
I'm not as bearish for next year as I initially thought I might be. If you look at the 26 Almanac outlook that I put out on May 30th, we had the reset, that we mentioned with the tariff tumble in April, and the fact that there's an easy Fed, and we've got several months. I don't know if you saw the recent stuff on the 7-month up streaks for the S&P. Pretty bullish.
Not bad.
Yeah. So,
So tell me this, right? And you made a lot of really interesting points there, Jeff. When you're describing 2025, I think a couple of your comments remind me of a point I think you made to me, years ago in one of our conversations that, see, and just tell me if you think I'm on the right page here, if you'd edit this way of describing it. But seasonality for me, I always think in terms of headwinds and tailwinds. And I think you sort of told me at one point, seasonality is what kind of should happen barring some one-off like extraneous influence. And so the tariffs come out, it kind of changes the whole dynamic very, very quickly. So you wonder what 2025 would look like without the tariff tantrum in the first quarter. And maybe it looks a lot like sort of the traditional seasonal pattern. Is that how you kind of think of it in terms of the balance between the seasonal tendencies, but then the actual sort of, big macro events that can cause huge shifts, right?
I agree. Yeah, that's exactly how we look at it. I mean, we probably would have had some of that weakness in the second and third quarter.
Yeah.
Especially the August, September, October were all new high months.
Yeah.
Excuse me, this year.
Those are some of the seasonally weakest parts of the year.
That's the weakest and most volatile, months. For several reasons. A lot of it has to do with the quarterly behavior of institutions.
Yeah.
Not just the cultural summer vacation, back to school, back to work vibe that drives it. But institutions drive the market and the economies, in the bond market as well. And then there's the October 31st mutual fund or 40 Act fund deadline where they have to reconcile their accounting for the current 10 months, the previous 10 months, the calendar year for year-end distributions to shareholders. And that creates that seasonal vortex, the October phobia, the September weakness. So we had that early. There was a more powerful macro force. Tariffs like we haven't seen since, a whole, lifetime ago.
Yeah.
If even the ones in the 30 with the Smoot-Hawley stuff was, I don't know if it was comparable. I don't know if we have the information or data to really compare it, but it was similar to it.
Yeah. And significant enough that I think it changed a lot of trends, right? Before and after, probably. You had mentioned the super boom pattern, and I religiously have the Stock Traders Almanac. Here's my 26 copy, and we'll put a link. So if anyone does not have it by now, they definitely should. It's something I have on my desk to kind of navigate through the course of the year, and I've done that for longer than I can remember. You talked about that kind of super boom. This is something you have one too. Huh? What are the odds?
Couple.
So you had written back in 2010 this idea of the super boom. This is coming off of the 2009 low, and in that you talked about incredible strength through 2025, which is pretty much what we've seen. The secular bull market, cyclical bull markets driving higher. It's sort of moving higher. What can remind us what you saw back in 2010 to sort of give you the sense that this is where we're headed? And if you wrote a book today about what's next, right, is it have a similar title or is the title a little different?
Well, first of all, this was a cycle that Yale discovered. My illustrious late father, who created the Almanac in the 60s, he discovered this in 76, coming off of the Vietnam, the end of the war when Saigon fell in 75, and this boom that was beginning. So it's based upon war and inflation. We didn't have the first one was World War I and the boom afterwards, the 20s, and World War II in the 50s and 60s. And then there was the Vietnam sideways, oil embargo, bear market stuff. And then we had the 80s and 90s, which is what he was predicting accurately as well. So without getting too in the weeds there, that's what we noticed coming off of the 09 low.
Yeah.
And we've we were earlier than he was, or because it was a few years later, and we also have a little more hindsight. So we've adjusted. Actually, in that almanac that you flashed up there on page 11, it goes to there is an update of it, a brief one, and the chart. Yeah, you got it. See, he knows. So thank you. We're looking at perhaps, like the 82, like August 82 low is the secular bear beginning, not the 74 low, the ultimate low. So '09 would be more like 74. And then we're looking at October 11. I know some people are talking about 2013 as well. We'll need a little more hindsight to be exact, but I think we're at that stage. So the new title is probably, the super boom goes on, the super boom continues. And if you look at that paragraph, I the number I think is 62,430 is if memory serves.
That's right, on the Dow.
Around 2030 with about 8.5 average, compounded annual growth rate of the market. It really dovetails with that fourth turning stuff I mentioned. So the new book might be something related to the generational cycle in addition to the boom cycle, the technological boom cycle. And I've got a spreadsheet in the works where I'm looking at the generational, the Strauss-Howe stuff with the turnings, with the secular bull and bear markets, with the 4-year cycle. I got to put some seasonals in there. We'll look at and I think events are important. Like if you look at that chart on page 11 there, it's not a time frame, and I think the Strauss-Howe cycle is also like that, where I put like the Gulf of Tonkin resolution, the fall of Saigon. These are 9/11. These are events that mark the beginning or end or inflection point of this cycle. So I'm actually actively currently thinking about a new wrinkle on it. So
I can see the excitement on your face as you're talking about it, Jeff. So I would say please finish that and write that book. I would love to read that, because and you've alluded a couple times. It's Neil Howe, William Strauss wrote this book called The Fourth Turn. This came out, and this is probably 20 years old, 30 years old. I mean, it's been around a while.
Forget what the initial book was. It's been around for a while. They wrote it in the 90s, but I'm currently reading his latest book, which came out in 2023.
Yes.
The fourth turning, like I forget the subtitle, but Where We Are Now. Yeah. And it talks about, the political climate that we're experiencing. It talks about those crisis things, whether it's the Mideast or the Pacific Rim or Russia, Ukraine. I mean, or it could be something. We've got some internal strife. There's this whole civil unrest thing that's going on. I mean, it's not fully fleshed out, and you never know how it's actually going to end. But it's really got my attention right now.
Jeff, if I can contribute anything to this book, and you're welcome to dig into these things. 2 things I would say. Number one, I mean, 3 things. Number one, I think it's brilliant because we often talk about generational lows, about once a generation, you have this big, very viable moment. That market history certainly, at least in my study, has definitely had that. The second thing would be within the technical analysis, I guess, umbrella, you have things like the Kondratiev cycle, which kind of attempted to categorize that, right? You have different seasons: spring, summer, winter, fall, and different social and socioeconomic things that relate to that. And then I would also say at Fidelity, we did some work on the demographic curve and how that would also be a part of that. And that ties into the generations as well, right? You have this big influx of people that are all getting old. You have a big influx of people that are all at investing age. They're all retiring. They're all passing wealth on. Some generations are smaller, and that creates some hiccups in it. There's something there. I hope you apply the rigor that goes into the Stock Traders Almanac to that.
I'm trying to. How are you with Python?
I
might
wish
need some
you well.
Programming help.
That is anyone watching that's ready to contribute some time and effort. Let Jeff know for sure.
No, we'll talk. You and I'll get together on this. We'll have to have a coffee.
This is something I've always been fascinated with that, and I know at Fidelity we did some work on that, just thinking about generational curves and the really important thing you recognize is when you step back far enough, there are these other cycles that we probably just don't appreciate because we're too caught into the short-term nuances. So
that's one of the things I was thinking about when I was just sort of reading the book and making notes and putting things together. Like, oh yeah, this is all great, Jeff. It's easy to predict the long-term future, but people want to know what stocks to buy now. And everyone's like, what's the ticker? Like, I don't care. What's your hot stock pick or whatever. So I mean, we've got some of that stuff. We've got Santa Claus Rally, another Yale invention, which gets misunderstood. We've got the January effect, which you mentioned, which is a small cap effect. And then there's a January barometer. We've got some seasonal trades. We've got a couple sectors coming in play.
Right.
So there's short-term stuff that we use the almanac rigor to uncover as well.
For sure. Yeah. Why not apply it to some long-term stuff too? I don't think that's a
Yeah,
bad thing.
no, it's I don't know. I find the long-term stuff a little more fun. You can see the look on my face,
I was going to
like
say you're lighting up, Jeff. That's the indicator I think you should be most keen to
yeah,
acknowledge. So tell me this, right? So as we now are getting toward the end of 2025, we've got the last Fed meeting of 2025
yep.
this week, and we're going into 2026. Talk to us a little bit for those that are not as familiar with the almanac in your work. How do you look forward to 2026? How do you think about the next 12 months, and what does that like midterm year usually look like?
Well, we start thinking about it, 18 months or more ahead of time when we put the 26 almanac together in the spring, wrap it up around Memorial Day and proof it through, the summer, July 4th and stuff. So we're thinking about it more like 18 months or so in advance.
Yeah.
And the 4-year cycle drives it. I mean, each edition it's on the 4-year cycle. I mean, the 26 is the midterm election year edition. The 25 is the post-election year edition. So there's several pages in each of the editions that relate to the year of the 4-year cycle. So that's a
Mm.
driving force there. And the thing about the midterm year, it's the one that's remained weak over many different time frames. The long-term time frames, the short-term time frames. I mentioned the post-election year is the best of the four since '85. Midterm's still the worst.
Yeah.
Still has this negative connotation, and it has to do with politics and fiscal, policy and what the incumbent administration is doing to retain Congress or get it back or minimize, the thinning of their majorities, however thin that might be. And we see this weak spot of the 4-year cycle in Q2 and Q3. Surprise, surprise, sell in May period, worst 6 months, but it sets up the sweet spot, which
Mm.
is from Q4 midterm year to Q2 pre-election year, like
Okay.
20% Dow and S&P, almost 30, it's 29.6%. I mean, there's a full page on it in the 26 Almanac for NASDAQ. I mean, Yale called it the bottom midterm years, the bottom picker's paradise. We
Yeah.
had the, textbook quintessential October midterm bear market bottom in 22. I wouldn't expect it to be as perfect next time around. And initially, we had thought we might be a little bit weaker, but rethinking the reset of the April tariff tumble and looking at some of the sixth year of presidencies, which is on the chart on page 10, I think, across
Yep.
from the one you were just looking at, and the second Republican midterm years, kind of the upper end, but more in the sort of average annual performance, 8 to 12% is what we're looking at S&P.
Yep.
But initially I thought we might get some bear market action next year. I'm not convinced. Probably gets a soft patch. Maybe look for a low in the June through October period. Somewhere in there, but we'll see what happens. There's going to be some macro events. I mean, the tariff stuff might start to have some impact, take some effect into next year. We're going to have a new Fed chair. There's always the geopolitical, arena and the exogenous event front, like we had in, February 22.
Yeah.
But all things being equal, probably be a soft patch in the middle of the year, seasonal weakness, and then another rally. Oh, one of the other things off the midterm low to
Mhm.
the pre-election year high is an average of about a 50% gain in the Dow. So
Wow.
50%.
50%.
NASDAQ, it's actually 46.3 is the Dow's average move from the midterm low to the pre-election year high.
Right.
I mean, we're cheating a little bit. We're doing the low to the high just to show you the move. All
Yeah.
right.
Yeah.
NASDAQ is like 66.6%.
Hmm.
Good chunk of those lows are around October. They're scattered throughout the year and the midterm year, but an amazing number of the pre-election year highs, that'd be 2027, occur in December, and a lot of them on the last day or one of the last few days of the year. So,
Right. So
mid,
yeah.
yeah,
So what you're describing next year, the midterm year, the last midterm year we had was 2022, which kind of followed what you'd expect, right? Pretty weak performance, major low September, October, and then strong Q4 that led to a really strong 2023. And so that would be, if we look forward, that would mean, third, fourth quarter of 2026 and potentially a major low. And that's, you're talking about that big, like 50% gain would potentially be like end of 26 into early 2027, and then strength through the year. That's sort of the normal seasonal
Yeah.
pattern, I guess. Yeah, right.
22 was textbook. The last 4-year cycle
Yeah.
was uncanny. And I was saying along the lines, like, this can't go on. It
Yes.
can't be this easy. There's no way. And then we got it in early 2025 this year. We got the the April surprise.
Yep.
2018 we had the Christmas Eve crumble as well, the last midterm year.
And that was the last year when Q4 was really rough. Was 2018, if I remember right? Yeah.
Mm-hmm.
Okay.
So it's a headwind tailwind type of thing,
Yeah.
with a 4-year cycle as what like seasonality. I mean,
Yeah.
if you look at our newsletter, when we put out our monthly outlook, there's the market at a glance. It's a 5 discipline. It's seasonals, fundamentals, technicals, monetary, sentiment. I mean, we look at all these things. Yes, we're the seasonal people. That's our foundation. Cycles, you can tell I get lit up when I talk about cycles, but
Yeah.
we've been known to look at a chart and eyeball a pattern here or there. I've looked at GDP and price to sales and earnings ratio and PEs and such. And sentiment wise, I like Investors Intelligence the best.
Okay, right.
The most consistent bullish and bearish percent advisors. People actually get paid for their opinions. Put call, I think, is a little broken with the way options have changed, with the 0 data, and it used to be good.
Yeah.
And the weekly put call out of Barron's, which they don't even do anymore.
No.
So you have to calculate it yourself. You'd get the that nice spike above 1 on a weekly, which would be a good low. But a great sentiment indicator that we all look at all the time, especially when it gets to extremes, is the VIX. The VIX at 50 in April was a screaming buy.
Yeah, right. Huge spike in the VIX, pretty significant low. And volatility now, I mean, essentially at 0, right? I mean, it's down in like the mid-teens for the most part here.
17.
So tell me this, right? So as we transition from 2005 into 2026, the 4-year cycle would tell you midterm year is probably pretty weak. You alluded to other things you look at, and I think justifiably so, along with seasonality, to kind of understand what's happening. Can you give us some examples of things that you would be looking for to validate, okay, yeah, 2026 is really, following that seasonal weaker pattern that we would expect? Are there trend following tools or something you would use to say, yes, this is a new bearish phase versus nope, this is still a good uptrend?
Well, we have these indicators, the Santa Claus Rally, the first 5 days, the January barometer.
Right around the corner.
We call it our January indicator trifecta.
Yes.
Yale invented this Santa Claus Rally and the January barometer, which is the full month S&P for January. As the S&P goes in January, so goes the year.
Yeah.
Santa Claus Rally is the last 5 trading days. First 2 of the new year. It's an indicator. It's not a trading strategy. As he said, if Santa Claus should fail to call, bears may come to Broad and Wall. That's the title of the page in the book.
Yeah.
So what happens is around this time of year, the market tends to be bullish. There's a year-end rally. Best 3 months of the year, November, December, January. The Santa Claus Rally, 1.5% or so in the S&P because the pros are in there buying up bargain stocks, sold on tax loss selling, and there's not a lot of retail people around. Everyone's on parties and on vacation and whatever and taking some time off, present company included. And, when the market doesn't go up during that period, other forces are at place. That's a sign to start looking for other indicators. So we stood on Yale's shoulder about 10, 15 years ago and took the Santa Claus Rally, the January barometer, and the first 5 days early warning indicator, an old one from like the 40s, and built this trifecta. And again, full page in the book on it, page 20, I think, if memory serves, that if we hit all 3, the market, the S&P is up 90.6% of the time, 90.
Yeah.
An average gain of 17.7%, up 29 of 32 years. So it's pretty significant data set, pretty good number. And I like it because it's not perfect. these something in O's, these big numbers in O's, they're bound to get broken. They're bound to get,
Yeah.
fail.
Yeah.
So that'll be one of the things that we'll look at. One of the major things once we put out our updated annual forecast. So we'll look at our seasonal indicators, and then there's the technicals, there's the fundamentals. So we'll look for continued strength in GDP growth and the job markets. I know there's some concern about the job market. I think it's still just a little bit consolidating. I'm not sure that it's so negative yet. We use some MACD to get in, to get out near the end of the best 6 months.
Yeah.
So those are some of the tools we'll be looking at.
I love it. And it's really well said. And what's really funny, you're absolutely right. It's page 20, and you know that off the top of your head, Jeff. So I can tell you've spent some time with the Stock Traders Almanac, which is pretty,
Just a couple minutes.
awesome. But you're right, 100%. I mean, that's where it is. And again, what I love about what you guys do every year is just through the course of the year, kind of dropping these seasonal nuggets that I remember. Oh yeah, I should really be thinking about the January trifecta right about now. So, and just to wrap that thought, because I would say in the month of December, in my experience, and you've probably seen the same, anytime there's a big up day, someone starts talking about how this is the Santa Claus Rally, and I try to gently remind them to hold on a second. That's not it. So it's the last 5 trading days of December, the first 2 trading days of January, and that's Yale's famous quote, which is awesome, about looking at that as an indicator, right? Just to set the record straight. Fair deal. All right, we've done it. We've hopefully silenced those comments. I don't.
No way. We have to do this every year. Every year.
I'll set an alarm to do this.
And then they talk about a Santa Claus rally for anything.
And it doesn't matter what,
for
right?
Bitcoin, for whatever.
So you just mentioned the word that I wanted to go to next. I know you've done some seasonality, obviously, on other things outside of the equity markets. 2 things I'd love to ask about. Number one, have you done seasonality on commodities, particularly gold and silver? Because gold and silver, I mean, silver is, raging to the upside here at year end. Does the seasonality that you see in precious metals, does that line up in some way to what we see with stocks? Or is there some different sort of structure we should be thinking about? Where are we at in that cycle?
Precious metals are a fourth quarter seasonal trade. There's a macro trade there as well going on right now, but seasonally, we're actually getting out of our gold and silver trades. We were in the GLD, the miners. I think silver took off. We didn't quite get the SLV. We use the ETFs a lot, but we made our money with the seasonal trade in gold and silver this year. We're wrapping up. We're I think we tightened up the stop on the GLD. We got out of the miners already. They hit our targets. But other metals coming at copper has been I'm in the COPX, the copper miners.
Right.
That's doing well. That was a trade. We're looking to get energy on a dip. Not the oil and gas commodities per se, but the stocks, the XLE, the XES. We've got some buy on dips stuff out on that. But gold and silver seasonally is over. I mean, it's ending right now. There was one of the old pages in the Almanac was fourth quarter gold. We used to trade it with before ETS with the ASA gold was the big correlation. So that was a featured page back in the day.
Right.
There's a whole few pages on sector seasonality in the pages I think 96, 94, 6, and 8. But the commodity stuff, we are working on putting together another commodity traders almanac. I can't give you a date because it's quite an undertaking with the way things have changed and with the current, but that's something we're looking at putting together with all the different commodity seasonal trades, or as many as are relevant. But yeah, gold and silver, end of the seasonal, probably a time to take some profits or at least tighten up or not go headlong into further long positions.
Yeah, fourth quarter gold. That's a good one. I'm gonna remember that. Talk to me about cryptocurrencies, particularly Bitcoin. Still a relatively young asset class, but we've seen a pretty significant turn here to the downside. How does that relate to your expectations, and what are your expectations in the crypto space, particularly Bitcoin now?
Well, a couple things. I'm out of my IBIT. It didn't work this year. The seasonal trade was off. As we've said, when assets or markets don't behave like they normally do during the seasonal period, whether it's bullish or bearish. Something else is up, something else is up here with Bitcoin. We had that automatic deleveraging with the tariff. That was it, October 10th. China US tariff thing triggered a bunch of things there. So we put a stop on it, and we took a bit of a hit. It wasn't a great trade for us this year. It worked in previous years. I think there's some issues there. I think there's a lot of leverage. I think strategies is emblematic of that situation. And then, our friend Adrian, the Burb, he's got some concerns about how it's trading, and I look to him because he's really got his finger on the pulse of the technicals there. And then, as we point out, 4-year cycle wise, midterm years have been horrible for Bitcoin. I'm not, again, it's a small data set. There's only like 3 of them. One of them, the fourth one was barely full. It was not even a full year, barely a half year.
Yeah.
So I'm kind of not enamored with the Bitcoin right now. I don't feel like it's working.
And certainly compared to so many things, I mean, at a time when so many things appear to be working and you can find strength if you're looking, Bitcoin and Ethereum stand out as charts that are most certainly not working right about now in December of 2025. Now, it's great points in there, Jeff. Jeff, this has been awesome. I hope we've dispelled some misunderstandings about seasonality, but really appreciate you talking through what we've seen and what to expect. I'm a huge fan of the Stock Traders Almanac, as I always remind you. I'd encourage people to pick it up. We'll put a link so people can do that. For those that are just picking up the Almanac for the first time, what would be your guidance to them to get the most out of its insights in 2026?
I mean, read the intro. Read the analysis of what we mean by certain things. Don't just jump in. The explanation of the bullish and bearish days and how we look at things and the notes on pages. Read my outlook, and then jump to the present. Get dialed in on we got the only free lunch on Wall Street here. The stocks making new 52-week lows. We got some trades. There's some sector trades, and also the back of the book. If you don't profit from your investment mistakes, somebody else will. Gerald Loeb's ruling reason, the investment survival checklist, some of the places to take notes, some of the indicators to track, and then just read the December Almanac, read the January Almanac. Look you kind of, and if you're just getting the 26, you want to hear what's going on for 25, go to our stocktradersalmanac.com, check out the archives. You can take out a free trial there if you click on something that's not that asks you to subscribe, and you get a free copy of the Almanac if you take out a subscription to the newsletter. There's, what is the page? It's get STA on my website. There's a discount code on there. You can get it for free with a subscription. So,
Jeff, this is a pleasure as always. Great to check in with you. Have an awesome holiday season. I hope we can check in the new year, see how 2026 is playing out. But in the meantime, take care and thanks again.
Happy holidays, my friend.
It was a lot of fun to talk with Jeff about all things seasonality and many other things as well. Thanks again to Jeff Hirsch of the Stock Traders Almanac joining us on the show today. Hope you appreciated that dive into seasonal surprises in 2025. As Jeff, I think, very openly shared, the market did not follow the traditional seasonal pattern. And that's because some big one-off macro events kind of changed the course of the year. And that is a reality of modern investing and something to keep in mind. However, I have learned, having done this a couple years, always looking forward at the year to come, thinking about that kind of traditional playbook as a starting point to what you might expect. And then thinking about how the year is progressing versus that basic sort of expectation has helped me a great deal at navigating bull and bear cycles, especially over my 26 years in the industry. So would encourage you to pick up a copy of the Stock Traders Almanac. We'll have a link in the description and the comments to get to that book. Also, we talked about a book on generational movements by Strauss and Howe. Put a link to that one as well. Really interesting book. Definitely made me think about longer term cycles, right? Sort of those big generational moves that end up, really explaining a lot about how the markets and how our society, how, social things sort of evolve from decade to decade. Really appreciated the thoughts about, the year-end sort of trifecta, the Santa Claus Rally, the January effect, the January barometer, what he calls the January, the trifecta, right? Looking at those three indicators and thinking about what they tell us about expectations through the course of the year. I know I'll certainly be following those along with Jeff into the new year. Appreciate you watching the show or listening to the show today. As a reminder, if you want to learn more about some of the technical analysis tools that we talked about in today's discussion, how to think about seasonality and cycles, but also have a thorough and consistent process of analyzing market trends, you may want to consider our Market Misbehavior premium memberships. You can go to marketmisbehavior.com/premium. For more info, there are 3 great benefits. Number 1, access to all of our virtual courses like Flight School Behavioral Investing, where we teach you all about behavioral biases and technical analysis tools and techniques to understand the world that's happening around you. Second benefit, all of our member-only reports like our weekly flight plan, our monthly chart review, and all sorts of random little market updates when something catches my eye. Finally, you have full and immediate access to our member community where you can ask questions. You can learn from other premium members. I'm in there every day answering questions, sharing a quick video, just sharing insights on what I'm seeing and hearing. If you are looking to upgrade your investment process to improve your ability to understand the markets using behavioral finance and technical analysis tools, go to marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for today. Thanks again for following me and my work. I'm Dave Keller with Market Misbehavior, reminding you it's always a good time to own good charts.